For April's consumer prices, it gained 3.8% year-on-year. Another burst in energy prices raised further concerns about inflation impact on U.S. economy. You can also see that there's a lot of selling in U.S. Treasury too. So there's some concerns and lower confidence right now. Energy prices jumped 3.8%, but on a 12-month period, it's 17.9%. And energy accounted for 40% of the total headline consumer prices gain. So other areas are also increasing. Food and home prices increased 0.7%. Shelter costs increased 0.6%. Apparels, which are sensitive to tariffs, also increased at 0.6%. And airline fares obviously will increase, this time around at 2.8%. But when you look at 12-month period, it's 20.7% jump. Inflation is the key drag on U.S. economy now, and the first time in 3 years, inflation is eating up all the wages gains. This will have some impact on middle and lower class income household. Real average hourly wages, with inflation factored, dropped 0.3% year-on-year. This will have some impact on U.S. consumers, but there's some cushion to this. Many consumers benefited from tax refunds this year, and hiring activities have picked up from the near stagnant rates from last year. And most businesses are generating robust profit growth. So there are some buffers to help weather this shock a little. U.S. consumption matters because consumer spending accounts for about 70% of all economic activity in U.S., and retail sales are responsible for about 40% of consumer spending. A direct hit on consumers, you'll see it reflected in retail sales dropping. But so far, it's still resilient. Currently, retail sales in April increased 0.5% month-on-month. There's still little sign that the higher fuel costs are forcing consumers to cut back spending. But however, looking ahead, the pressure is already building up and expected to build up even more. And energy prices will likely remain high throughout this year, even if there's a deal to reopen the Strait of Hormuz. Looking at producer prices for April, it's the highest annual increase in more than 3 years, coming in at 6% year-on-year. And excluding food and energy, the core one is also high at 5.2% year-on-year. It might be more comforting if the gap between the two is wider, but for April, it's not. Even when energy is excluded, it's still high. That means it's a deeper structural trend right now, especially in services, which is the core number. Next, markets are pricing very little chance of interest rate cuts this year, and the odds of a hike increased to 39%. So then, let's look at the new Fed chair, because Fed maneuver the interest rates. Kevin Warsh got confirmation to be the next Fed chair. He won by 54 versus 45 vote. This is his second stint. His first time was in 2006. Trump has made no secret that he expects Warsh to lower interest rates. But it's a tough time because inflation levels are picking up. We'll only know more during the next Federal Open Market Committee meeting in mid-June, which will involve Warsh. There's good discussion points from the U.S.-China summit. Both agreed to be more cooperative. The two agreed to be constructive with strategic stability and at the same time to have measured competition. Xi Jinping called for deeper cooperation in economic and trade issues, and agriculture and tourism. The two also discussed expanding market access to U.S. businesses into China and increasing Chinese investments into American industries. Trump called for continued efforts to curb fentanyl flows into the U.S. and purchase more U.S. agricultural goods. Both agreed that Strait of Hormuz must remain open, and China also expressed interest in purchasing more U.S. oil to lighten its reliance on Middle Eastern crude. Both agreed that Iran can never have a nuclear weapon. And lastly, Xi Jinping reserved his sharpest language for Taiwan in calling it the most important issue in U.S.-China relations. This is a subtle warning for U.S. not to interfere. China economy in April, consumption, industrial output, and investment growth all missed expectations, and a lot is due to Iran's war. Retail sales only grew 0.2% year-on-year. The forecast was 2%, and March and February were good. This is the weakest growth since December 2022. Industrial output gained at 4.1% year-on-year, dropping from March and February. Fixed assets investments, which includes real estate and infrastructure, for January to April this year, dropped 1.6% year-on-year versus 2025. But January to March this year versus last year, it gained 1.7%. Most of the decline is due to property sector, with flows plunging 13.7%. But in a period of January to March, the drop was 11.2%. the decline worsened, but other areas grew. Investments into infrastructure and manufacturing grew at 4.3% and 1.2%, respectively. Property investments nearly halved since the peak in 2021. Any further decline will deepen the hit in household because the property downturn has already inflicted significant job losses in construction and related sectors. However, the good thing is the strong exports in China help mitigate the rest of the weaker areas. April exports gained 14.1% year-on-year, and this is due to the surging overseas demand. Foreign buyers are stockpiling over the fears of higher input costs from Iran war. And to wrap everything up, China's economy started with a good note. Q1 GDP is 5%, and the government made boosting domestic consumption a growth priority this year, which is what they really need to strengthen. On to Japan. For Q1 annualized this year, the economy grew 2.1%, a decent number because of improved consumption and strong exports. But the full impact of Iran war is not captured in this number because the war started at the last day of February. Expect the economy to feel strains from high energy costs ahead. The latest exports number is March, which grew 11.5% year-on-year, thanks to the jump in shipments of semiconductor equipment at a 29.3% jump. Bank of Japan cut growth forecasts to 0.5% from 1% and raised core inflation outlook to 2.8% from 1.9%. The bank warned that economic growth would likely decelerate because of the high oil prices, which will affect corporate profits and real household income. Next, Japan will likely issue new debt, which they already have a lot now, but the new debt will be used as a cushion to the economic blow from the Middle East war and subsidizing energy bills.